the monetary side of things for Ethereum are probably the strongest it's been in a long time. If anybody remembers the FTX implosion, Ethereum did not make a lower low. And part of the reason, at least why I think that's the case, is that there was an increase in M2 during that time period. It's almost as if Ethereum is trying to invest in public infrastructure, if we're to view this as like an economy. And will that change in public infrastructure, which is currently impacting things, will that pay off? Will there be an ROI so close for the Bitcoin economy to like realize this change of usage for its token outside of kind of pristine collateral and sending payments? If it can cross that threshold, man, God, it becomes the best asset hands down.
We are back with Ben Lilly, managing partner and head of research at J Labs Digital, continuing the conversation on his new model for understanding tokens. If you listen to part one, which of course you should have, we were talking about breaking down a token into its various components, which include network, monetary, technicals. Ben, we could talk about all the models underpinning this, but you and I were talking offline. It probably makes the most sense to really look at this from an actual example perspective, and that takes us to Ethereum. Breaking down Ethereum. Are you ready to do this? I know this is a beast. I know it takes a lot of effort, a lot of brain juice. Are you ready to do that?
I mean, this is it just trying to mature as an idea and take shape, and it's going to be bumpy. So we just got to power through it.
Okay. Well, I hope you got your Red Bull and your coffee. I know you're, as the masthead says, right? You're espresso, so you're always jacked up on something. Okay, so let's kind of set up the conversation for folks who listened to part one. There was a lot of meaty conversation in there. We talked about Metcalfe's law. We were talking about M1, M2, M3, this idea of demand sinks, if you will, the difference between tokenomics and your token rating model. I think let's take the M1, M2, M3 idea and really start to solidify that, because I think for most people coming into crypto, looking at these projects, they have so many vanity metrics that they're going to come across that are going to come from people that are influencers, perhaps even VCs that are focused on that. And I know you talked about that. That's even part of your origin story of why you wanted to get into this. So let's really talk about what demand looks like. And I know you have some good examples that you wanted to share. Can you start going through that? We talked about COVID. Maybe that's the best place to start.
Yeah, I think it is. It's relatable. We pretty much everybody here, I hope, has kind of lived through that. If you didn't, then you must be a time traveler. But, assuming you're just kind of a normal individual like the rest of us, we lived through COVID. And in 2020, we all saw the printer go burr. There was so much money being flooded into the system. But what many don't remember is that in that time period, everybody was essentially sitting on the edge of their seat wondering, where is inflation? Why isn't it reared its ugly head? And it was like month after month, we're kind of like waiting to see CPI numbers come in. We're looking at some of the goods in the market and be like, where is it? It's not here yet. And to answer that question, I guess almost in a simple form, like you have to break it down into two different buckets. And these two different buckets are essentially the monetary side of things, the supply. And then the second bucket is really like a catalyst. It's the demand part of the equation. And so as you understand these two different things a little bit better, and as it gets clearer, as you start kind of using those two items and moving it from the COVID situation and then moving it to Ethereum and other tokens, it really kind of cements this idea of what this kind of token framework that we're alluding to here is all about, and how it impacts, how it helps people understand like a token's value for the protocol. Is it going to go up in price? Is it going to go down? Does it really need to be there? And is it a good investment to make over the long run?
Yeah, Ben, I want to interject here. Sorry, I probably cut off your thoughts there, but there's something really meaningful about having a model in place for your understanding, which is what your token rating system is, and allowing that to have the time to process, right? Because as you just mentioned, during COVID, everyone saw all this money come out. They were expecting inflation overnight or in the next month, and it didn't really hit. It's having faith that your model is a good one, and then allowing the time for it to pass and process. Just something to keep in mind. I think that's frequently overlooked, right? People are impatient, especially in crypto.
Absolutely. Like on my screen here, you can see the personal savings rate in the US economy during that COVID era. And you can see when the money printer started to get turned on in 2020, and everybody was really kind of panicky. Everyone was worried that they're going to need to essentially hoard cash, really stock up their savings accounts for the doomsday preppers, right? They were starting to load up their bunker, if you will. But here you could see that the savings rate went over 30%, right? And it really, if anybody remembers that time period, inflation didn't hit until the summer of 2021 when lockdowns came to an end.
Mm.
And you can see here, right at that time period, savings rates were starting to drop because now individuals were willing to spend their money. So if we just look at this chart for a moment, you can see, like, yes, there was a ton of money coming into the economy, and the supply of the currency was really being degraded. The
Mm-hmm.
purchasing power of that currency was degraded, but it wasn't actually out in circulation, right? So in the background, you had this shift taking place over many months, right? And this is, kind of the analogy I like to use is like the landscape was changing below your feet,
Mm-hmm.
but you couldn't see anything. And as far as what you would see, that would be CPI, that would be the price of goods and services. And it wasn't until everyone kind of came out, started spending money at restaurants and bars and ordering goods online that you really saw that uptick. And that's when the savings rate was coming down. And so if we go ahead and we were to look at what this inflation rate was starting to look like, you could see in the second half of 2021, it showed up. It showed
Mm-hmm.
up and it didn't slow down, and neither did that savings rate. And going back to that savings rate, you can kind of see over here in the kind of early to mid 2022, savings rate kind of bottomed out. Inflation did as well. And so just that basic principle of, sure, things were changing in the background, but the result wasn't seen in the forefront yet,
Mm-hmm.
right? That first part, the background, that's the monetary side of things. That landscape is changing. But then you need the second part, that demand characteristic, that catalyst to show its head. And to summarize this, I'm not sure I have it in this paper, but in the way we can look at this is that quant money of supply, which here is that equation that P equals, let me share it on my screen. I apologize, but it's P equals MV over Q. This MV, okay, so if MV, this is supply and it's the velocity of money. MV, if that starts to rise, because one of those values starts to rise, that's the top half of this right-hand side of the equation. So this P value is going to rise. Now, this probably seems a little weird because I'm saying, oh, a ton of supply is coming in, the velocity starts to rise, so P is going to rise along with it. Now, that is essentially what the cost is for everything in that economy. If the cost is starting to rise, that means the value of your currency is going down. All right. So these two little letters here is what I mean by essentially M being the supply, the background, the monetary side of things, and V is essentially the demand side of things. And as that starts to tick upwards, this is going to cause this equation to blow up higher. And that is what happened during the COVID era. Right.
Mm-hmm.
So if we can just sit there, understand that basic principle, these two little letters right here, understand how that impacts price, we can take that model and start to look at crypto tokens through it and better understand how supply, how demand of the network impacts the price of the token.
Well, let's take that and think about it for Ethereum, right? Because I know you mentioned sort of the earth, or the, moving under your feet, starting to grow under your feet.
Mm-hmm.
People looking at these changes starting to happen in an ecosystem long before the price hits, right? So long
Mm-hmm.
before the price actually changes, which is what many people are looking for, right? Is that price catalyst. But
Mm-hmm.
it's looking to get in early before that catalyst even hits, but for trying to strike those fundamentals. So I think you have an example where you show the fundamentals starting to build up before the price catalyst hits, and you actually see that explosion in price. Is that right?
I do, and it might be helpful to kind of explain some terminology uh, in terms of how how we can classify tokens, like we mentioned, like, yeah, dollars during the COVID era was sitting in a savings account and then it was essentially being spent. That's really different forms of liquidity. So if it's sitting in your savings account, that requires a step, that requires an action to be spent. You move into a checking account, or you need to go ahead and make that transfer before you go ahead and spend in the economy. That's a transfer between a more illiquid state to a more liquid state. And the reason you have it in a savings account is because it's earning. Back then, I don't think we were earning much interest in a savings account, but the premise is that you're earning more interest, right?
Sure.
So we break that, where you sit that money in these definitions of M1, M2 supply. I think most listening here today have heard about what M2 supply is. And M1 is a more liquid version of dollars. It's more of dollars sitting in your hand willing to be spent. And to really cement the difference between the two, because this is how we're going to apply it to crypto, is you can look at the change of M1, essentially the M1 supply over time. And I have that up on my chart here. And if you recall, it's the summer, or I guess inflation was topping out in kind of mid to early 2022. That's when it topped out. And here you can kind of see this red line here. That's the supply of money coming up, and it tops out right around that period of time. The overall supply was rising as well during that time. Now you kind of then had the supply just go sideways. This is the overall of M2 supply. So you can think of that as really money in circulation. It just went sideways, right? There wasn't more money, there wasn't less money. But under the surface, you could see that money was starting to change now in 2022 from sitting in your hand to moving towards essentially savings accounts, if you will, short-term kind of duration assets that are a little bit more liquid, right? This changing of where money was sitting and essentially how it was being used and how liquid it was, that really was that pivot. Okay, so as money moved into M2 and away from M1, it became less liquid or illiquid. And that higher form of usage is really what helped keep inflation at bay, right? Just keeping that in our mind, understanding those subtle differences, we can apply that same sort of thinking to looking at tokens. Because if you were sitting with cash in your hand, what's the equivalent in crypto? It's tokens sitting in your MetaMask wallet, if you will, and you're ready to go ahead and spend them. And so we can classify tokens sitting in a wallet, not a smart contract, but just typical old wallet, as M0 supply. Makes a lot of sense. And then we mentioned there was essentially a savings account. That was a higher form of usage for a token. It wasn't necessarily locked up, so to speak. And in crypto, what would be that next step, right? Where the money's still liquid, but it's kind of a little bit less liquid. And that would be sitting in a smart contract. A great example of this is sitting in a DEX liquidity pool. You can go ahead and you take your tokens, you drop them in there. They're still fully liquid. People are trading them. They're moving in and out of that pool, but they are sitting in a smart contract. And ideally, you're earning a little bit of interest or a yield based upon all the trade activity that's happening. You can also have a liquid staking token like staked ETH on the Ethereum network. It's essentially you drop that ETH into a smart contract, okay, but it's still fully liquid and it's going into a higher form of usage and earning a little bit of yield. And so that's how we can classify M1 here. But if we were to take it a step further, you can kind of think of dropping a token into a smart contract and it's being fully liquid as M1. If you're dropping a token into a smart contract and it's not fully liquid, and maybe it requires another action to go ahead and make it liquid again, this would be like lending tokens to a lending and borrowing protocol, right? Or maybe locking ETH up to the beacon chain natively, not through a liquid staking token, but just straight up locking it. In both situations, it's not a fully liquid token. There's some sort of action that has to take place before it can be traded, before it's liquid again. And it is earning yield. It has a higher form of usage that exists in the marketplace. And so right there, we can kind of classify tokens that are locked up in that fashion as M2. So right away, you can see moving from M0 to M1 to M2, this is really like an index in a way, where you're moving from one side where it's very liquid, it's a lower form of usage, to less liquid and a higher form of usage. And this was kind of a concept for anybody studying quantity theory of money from that book way back in the day. Like that was really kind of how these economists were thinking about money at the time, which was either liquid, illiquid, or low form of usage, high form of usage. You want people to use your token, gain more usage out of it. And so M3 in this category, just to wrap a bow on it for these definitions, is supply that hasn't really hit the market, right? It's got a time component to it. This would be tokens that are being held in escrow or held for vesting, kind of not yet locked or unlocked, excuse me. There's a time component, and once that time component expires, then it can be unlocked. We classify that as M3. We don't, cat out of the bag, we don't really follow M3 as of yet, because for now, M0, 1, and 2 do a great job at getting this visual into a token economy.
Ben, I want to, I guess, simplify this. Maybe it's the way I interpret this. You had a formula that you shared just a few minutes ago, and in that formula, velocity was part of that formula, and you were talking about the price of items. If you go to the M0 through M3, you have the higher form, which is, these are demand areas where the money would be used. And I think higher form is kind of a relative description of what that means, but it's saying basically you're getting more value for putting your money into something that is actually going to take velocity out of the economy. Is that a correct understanding of what you're saying?
It is. It's like an inflationary sinkhole. And as more money moves to those higher forms of usage, and this would be like 30-year treasuries in the TradFi example, inflation gets tamped out because it's not being moved in the market, right? It's not being transacted at a very high rate. As new money enters and it starts moving in, your inflation is going to be jacked up. But if you can take it out, have it stop moving around, that's going to be essentially a positive.
So all things being created equal, a token that has more of these opportunities, these demand sinks that have value, right? It's not just locking up your token and not giving you anything for it, but it's having a step ladder of ways in which you can lock up the token, moving towards something that's an M3 that's saying, listen, there's value in you locking up your tokens for a longer period of time. These are things that you want to be looking for because it's going to reduce velocity and it's going to add value to the value of the token relative to the economy. Okay.
Yeah. And real quick, an early criticism to this way of thinking was that staking rates for some of these more, I don't want to call them ghost chains, but like chains where they haven't really had a lot of application development. There really wasn't many use cases that existed. And the primary use case was just staking tokens. And so someone was like, well, I could just stake a bunch of tokens and then that would really maintain the value of the token. And to that, there is some truth to that. But the flip side is everybody was staking to preserve their purchasing power on the network. And so if the staking rate was 7%, and that's what anybody who staked their tokens to the network was earning, the ratio in terms of the amount of tokens being staked relative to M0 or M0 and M1, right, it wasn't usually in a good position. The amount relative to M0 and M1 was dropping. And that's not the ratio you would want to see if you wanted those monetary conditions to be strengthening.
I think the point there, I would say for any investor that's looking at any of these tokens, is to realize there's not just one metric you can look at, you can point to and say, oh, look at everything that's being staked here. It clearly shows demand for the network. This is one of the reasons that your model has network, monetary, and technicals, and that when you're looking at demand, you're looking at other variables as well. This is just something I would argue for any investor needs to be aware of and asking and demanding from their investment. If you're looking at a token saying, okay, what are these demand sinks? What exactly is the token used for in your network? And then not just saying, oh, well, we have 80% of the token that's locked into staking to get more rewards. I think to your point, that ratio is probably, it's not accretive to the value of the economy.
Yeah, and I don't want to get into like the individual models because they get a little confusing, and I'm trying to keep it as simple as possible. But like when you look at monetary kind of the supply side of things, like how is that token spread out through that network? Like the diversity of these use cases, it does matter to a degree. We don't see it mattering as much as some of the other models. If anything, what we find is that as a network, you would want a lot of different use cases for your token to happen when things are kind of depressed. But then as the economy starts to strengthen, you see price starting to rise as well. You tend to see like that diversity drop. And that's because there's basically a handful of protocols that found product market fit within that economy or token economy or network. You see that product market fit, and then you see the concentration of tokens kind of emerge as well. And so diversity starts to drop. And this tends to happen in traditional economies as well, which is basically like kind of the concentration of wealth starts to rise, but that also coincides with like a rise in GDP. And it's a similar process, like a big tech movement just takes place. And basically a bunch of tech giants make a lot of money. You have a concentration of wealth, but you also have an expansion of the economy. So that's how diversity works. But to a degree, if you only got one use case for your token, you're a little in trouble because then it's either you form new use cases to create increased diversity, which kind of goes against what I just said, or you're going to have a flood of activity in terms of moving out of staking and into the real catalyst, which I don't think we've addressed yet, which is the network side, which is the demand side of everything.
Let's take this concept, right? You talked about M0 through M3, these demand sinks. Let's take that and talk specifically about Ethereum. What does it actually tell you, maybe historically, about what that implied for price at different periods? I think you have some data here that you look at and show sort of how that was building up, and then what it actually meant from a price perspective when a catalyst hit from a demand side.
Yeah, so a good time period to look at for that is DeFi Summer 2020. That was essentially a 0 to 1 moment for the Ethereum network. A lot of tokens went to a lot of different use cases virtually overnight. And if we went ahead, what we did, we went ahead and we took the ETH tokens in supply. We categorized them based on what I mentioned before, M0, 1, and 2. And then we charted it over time, and we produced a chart that looks a lot like we have here. And if we look at when has historically, we've seen major changes in terms of the supply, in terms of M2, really. What happened to price? Well, in 2020, around DeFi Summer, we saw around June 23rd and a couple days prior, a major shift. Like this coincides with Compound releasing their comp token and attracting a lot of capital to its network. And then basically that created a catalyst for a lot of other protocols to go ahead and kind of copy that model. And that was really the birth of DeFi Summer. But the supply changed and it happened really quickly. But if we actually go ahead and we look at price of ETH, nothing happened right away. So here we are in June, which is the same time period I showed on that M2 chart earlier. And we just kind of went sideways and we actually dropped a little bit in the days that followed. This is that concept that things are moving and changing in the background, but you're not seeing it in the forefront. The monetary conditions are improving and strengthening, yet you don't see the results. And so this was another kind of complaint, if you will, and criticism of this way of thinking. And that's where this network side, this second stool of this three-legged stool that I keep bringing up, comes into play. And that's the demand side, is that we go ahead and we actually just easily look at an easy a metric, average transaction fee chart, and we can see there really wasn't much taking place in that kind of mid-June period and end of June. Right? And price didn't move. Price didn't respond. There was no catalyst there. The velocity didn't move, right? We didn't have our COVID time period lockdowns dropping middle of 2021 moment for all of this. When it ended up taking place was the next month in July. We started seeing activity start to rise. You can see this chart starting to really show a trend forming kind of in mid to late July. And if we go back to that price chart, you can see that subtle change in trend coincides with a massive move in price. And so conditions were changing overnight in a way, but price didn't respond until the catalyst formed. And then you essentially had price discovery take place. And it's a little hard to visualize, but what this monetary part of the equation does is people like to use the word convexity. And when we're talking about monetary and supply and velocity, all these terms from economics, it has to do with, in terms of the form of convexity here, is inelasticity, which is essentially you get that one unit change in demand, which here, this is those transaction fees starting to trend higher, right? That is your change in demand, creating a greater than 1 unit change in price. And so that's what we see here. You're having essentially a doubling in demand in a short period of time, and you're having a more than doubling take place in price. Right? A 1 unit change in demand is creating more than 1 unit change in price. That is convexity. It's also called inelastic response to that demand. And that is really at the heart of what we try to focus in on with this framework: strengthening conditions, weakening conditions, and then when does that catalyst hit? So this is really that first example of DeFi Summer in 2020. And for anybody that read the QTT essays, I don't remember which one this is. I think this was part 3. I go ahead and I actually break down a bunch of examples where we kind of see in the background these monetary conditions starting to change. So right here, you got September 2020. I think around that time period, I know Uniswap, that would fall into the M1 category, but you did have a lot of other protocols coming in, people locking tokens up in the pickle jar, if you remember that. A lot of people trying to farm yams for anybody around back then, right? This is why we kind of had that liquid supply just going sideways, right? But you had a lot of tokens starting to get locked up. And then you can see right there, price just responded pretty quickly within that October, November time period. And similar thing, you had that response on the demand side as well. So there's a lot of examples in Ethereum's timeline where we see that. And it works the opposite way as well. So here we had let's see, this was November 2021, it looks like. And you had a M2 started to move towards M1, right? So tokens went from an illiquid state to a more liquid state. And that's that blue band on my screen right here. That's kind of the amount of tokens that are sitting in a smart contract and they're liquid. And then this purple it's shrinking. And so if we look at the time frame, looks like October, end of October 2021. We go ahead, we drop that on the chart here. And you can see that was really kind of the topping out moment in 2021 when price got real close to hitting the $5,000 per ETH mark. Right. And just to kind of pile into that, if anybody remembers the FTX implosion,
who can forget, right?
I'm sensing a little PTSD here.
Oh, yeah.
Ethereum did not make a lower low, but Bitcoin did. And part of the reason, at least why I think that's the case, is that there was an increase in M2 during that time period. Right? In September, when we hit the low for the market, at least for Ethereum at the time, there was a change in direction in terms of the supply. And in September 2022, that happened. M2 started to rise. And then in November, we got SBF doing his thing. And then ETH did not form a new low. Reason being, in my opinion, is that more of the supply got locked up during that stretch. And so as demand waned, right, or the selling pressure increased during that time period, there wasn't as big of a reaction because in the background, things were changing.
So I want to summarize all the examples that you just gave for Ethereum, show you how going from an M0 to an M1 to an M2, M3, moving up that, it's kind of a precursor, or can be a precursor to price movements. There's a bit of a delay perhaps in that activity before it happens, but it can be a good signal to suggest that something will happen, or that the network is primed for a catalyst, right? That if there's a news event, if there is new capabilities or maybe an upgrade on the network, et cetera, you now have a network that's really ready for that price to move.
Absolutely.
Okay. So
Absolutely.
I want to then take us forward to where we are today. And you may have something else you want to share, but I want to ask the question that's probably on a lot of people's minds right now, is that we're looking at Ethereum in 2024, last 6 months, and so much of the activity and so much of the focus is on the ETF, which if I think about it from your model perspective, is kind of an M0, right? It's a very liquid form of that. And it's not even really that, because it's almost a paper version of it, but maybe we can use that as a proxy, but it's kind of buying it and holding it and really able to sell it on any given part of the day.
M1.
And then
I'd probably classify it as M1, right? You're
okay,
almost
so you put it as an
containerizing
M1.
it and it's still fully liquid.
Okay. How do you think about the demand side right now when you're looking at Ethereum, and whether or not it's done a better job from the examples you were just giving, going back to 2020 of DeFi Summer, and how much of it is moving into these higher forms of usage?
Yeah. So right now, the monetary side of things for Ethereum are probably the strongest it's been in a long time. And I have a feeling that there's going to be a bit of disagreement from the listeners here when they hear that, because if any what is that site, like Ultrasound Money? They like to track the supply growth or shrinkage over time, and then you can kind of choose the time period based upon how much was burnt or how much new supply was added, and then if you want to annualize it. And it's been not progressing in the best way. And there's been a lot of people that point to that, saying, hey, look, the supply is trending upwards. And then some are fighting back and saying, you know what, that's not as bad as Bitcoin, or and some saying it's actually worse. But it's besides the point.
Yeah.
Right? It's sure, your top line of supply is rising relative to what it was about a year ago. But the underlying usage of the ETH token has changed dramatically in just this year alone. And that is really thanks to the liquid restaking token thesis, because you had basically the emergence of liquid staking tokens, like staked ETH, for example, or Rocket Pool ETH, and those tokens sat at M1. Right? Before that, anybody that wanted to earn yield was just locking their tokens to the beacon chain. And that sort of supply is formed as M2, right? It's a higher form of usage.
Higher form of usage, less liquid.
Yep. And so then you make those liquid staking tokens, you basically drop it down, you give it some more liquidity. It's not the best conditions you want for your supply, but then now you have liquid restaking. And I know there's a lot of hate, in terms of either security or just the financialization of Ethereum. Let's not get into that debate, because that's not really the point here. It's more of like these tokens are moving back into M2. They are now going to an even higher form of usage by providing security to other networks, layer 2 networks. And so as we look at the breakdown of supply, it's actually never been as strong as it is recently. But then the question is like, okay, so the background is changing so well over the course of the last year, but Ethereum hasn't really responded in price. And we can just pull up that average transaction fee chart, and I'll go ahead and zoom in. And before actually I zoom in, you can kind of see historically like how high these transaction fees were. And then you can kind of see a run in early 2024. And right around kind of that end of first week in March, we kind of top out. And if anybody remembers what was going on, Ethereum just went ahead and into DIP 4844. This changed the fee landscape a little bit, especially as it pertains to L2s. And what it ended up doing was, you can see right here, fees dropped like a rock. This was kind of seen as a very good thing. It's going to enable L2s to go ahead and scale and market prices to be more affordable across the board. Was that the best decision to be made? You can slice and dice that anyway. The market was really hot at the time. If anybody remembers, I think it was around the March 13th, the market topped out. So we don't necessarily know how high price was going at that time when they went ahead and implemented. And there's a lot of things that have to happen before something gets implemented, right? So it's almost a coincidence. Right? It's not like, oh, price is going up, let's implement it today. Like that's, Ethereum's a slow, conservative moving machine there. So it was a coincidence, but this is the impact of it, right? Fees are very low. Your demand catalyst has dropped like a rock. And that's not boding well for price.
And would you say that they're almost a victim of their own success? They put forward these changes to actually make the Ethereum network less expensive. There's complaints about congestion. There's complaints about the cost of using Ethereum versus some of these other L1s such as Solana. So they're constantly looking at efficiency from a development standpoint. The architects are looking at this and saying, how can we drive this down? Let's push more of the demand to the L2 landscape. But then there is a direct impact on the price of the underlying token for the economy.
It's almost as if Ethereum is trying to invest in public infrastructure, if we're to view this as like an economy. And will that change in public infrastructure, which is currently impacting things, will that pay off? Will there be an ROI? Will essentially new businesses be able to come in, take root, and find product market fit and bring users in, increase the demand for block space and security? Is that going to happen, right? So Ethereum made that decision that it wants to push a lot of activity out onto layer 2s. And so here's a prime example of Ethereum going through its growing pains. It made the decision to go ahead and do that. And a lot of people are quick to attack it right now, but this is part of its maturation period. This is the growing pains that it subscribed to. Can it overcome it? And that's what we have yet to see. Is there going to be an application that somehow changes things? Is there going to be an L2 that demands everybody's attention like Base? We'll see, right? We currently don't see that at the moment. And if we are going to see it, it's going to show up just right in the amount of demand, which payment for block space, that's essentially the number one use case for the ETH token. That is number one. And if you have that use case rising, because the fees are starting to rise as well, activity's starting to rise, more users are coming in, right? That right there is your catalyst. So great, monetary side of things looking fantastic, right? The way that the flow of tokens are moving into higher forms of usage, they're going from liquid to illiquid. And I don't mean like HODL rate of 1 year type of stuff, right? That's behaviorally speaking, just different nuances of M0. Like this is different. Because we like to, at least for Bitcoin, because it does, I don't want to get any flack for this, but like it does lack some use cases right now. So the way that you want to essentially look at these different forms of how liquid a token is, it's really just behaviorally speaking. Historically, when was the last time Bitcoin was moved. If it's been over a year, well, tomorrow they're not that likely to move it. If it was 7 days, then you know what? Tomorrow it might move. But they're just nuanced versions of M0. This right here, the token's moving to a higher form of usage. It's being productive.
Mm-hmm.
And that right there for Ethereum, it hasn't been this good, this solid for a long time, but it needs a little kick in the pants here in terms of its demand.
Well, and said differently, you need some use cases, some product market fit, some products sitting on the L2s that drive up demand of those L2s coming back to block space on Ethereum.
Absolutely. And for Solana, because Solana is kind of the golden child for the past quarter. Its use case was meme coin trading. The market wanted that, and there was a lot of demand for it, and it responded accordingly. And its token, right? If anybody has been tracking Solana, its lending and borrowing protocols were increasing the caps to allow more SOL to be deposited. And this was happening before the meme token phase. And so conditions were ideal on Solana when that demand catalyst showed up. And that's why it had such an explosive move in price. And of course, we can look at some technicals, like it was like so hated, so oversold. And that played into it as well. But sticking to these two concepts right now, like the SOL token was getting locked up. It was moving to higher forms of usage. It was no longer just about staking. And then you had that demand, that catalyst form, and kind of that product market fit show up. And it just ripped. And right now, give a lot of credit to Solana. Its demand catalyst has dropped like a rock. I remember seeing that on one of our models and thinking, Solana is going to have to overcome this here soon. What it's been doing, which is very interesting, is it's following some of these use case examples that Ethereum has set, and it's applying it to its network. And you're now seeing liquid staking tokens. I believe I even saw like a Bonk Sol liquid staking token and a Helios Sol. And what's happening is individuals can go ahead and lock up their tokens to these entities, and they go ahead and they figure out ways to make more yield. I think Helios was doing MEV on top of it, and in a way that reminds me a little bit of what liquid restaking tokens are doing, right? And they're moving to these higher forms of usage. And to me, like seeing the emergence of that in Solana is actually giving it almost a situational setup to have a good second half of the cycle, as long as it can have that demand catalyst show up. And historically speaking, I think we can say that that's going to happen, because when do meme token rallies happen? Well, it tends to happen after Bitcoin makes its run. And, if we're hopeful that the Bitcoin cycle isn't over, then I think Solana is in for a good second half.
Well, we're definitely hopeful for that. I want to pin you down a little bit, Ben, on probably what some of the frequent listeners of the Trading Pit have heard, and going back even to our previous show, Alpha Bytes, where they would make this claim that you are sort of an Ethereum maxi, right? Well, take the entire conversation we've had, part one, part two. You've been looking at this sort of different ways of thinking about demand, M0 to M3 on these networks, and you've been studying that. You've been putting together these token rating reports focused on that. So you've now been studying Ethereum, not just as an investor, but now with this new framework for quite a long time. Are you seeing a continued strength in Ethereum? You just mentioned all the challenges it's facing right now. Demand for block space on Ethereum right now is low, right? But if you look at the whole card, the entire ecosystem or the entire economy, from a demand side, are you seeing signs of strength that are making you think that we're moving into a period? And if you combine that with the ETF, that really makes it a great setup for Ethereum, or not. I guess it's just an honest take of what the rating is telling you right now.
I'll say something that might be surprising is that I don't see it right now. However, an ETF, positive news and price essentially cures everything, right? Like it's a positive factor for the market. And as trading starts to increase, transaction fees are going to rise. It's going to have more addresses show up on the network. And it's really just a byproduct of essentially price going up. Now, that doesn't mean all is well under the surface. And I fully expect once the ETH ETF hits, starts trading, as long as there's good inflows, the price is going to rise higher, and we're probably going to see average transaction fees rise. What happens on the heels of that? That's what I want to know. How sustainable is this rally going to be? Are we going to see new use cases start to gain traction? I know everyone's talking about real world assets having a great use case. Is that going to be it? A part of me thinks no. And for me right now, everybody gives Ethereum a hard time with this over financialization. And I think there is a lot of financialization, and they're all sort of baked in speculation. Like even lending and borrowing, I've been writing an essay on that. And you go ahead and you think about how are these rates set in a lending and borrowing environment? A lot of it is really just speculative or byproducts of speculation. It's the demand for more stable coins and dry powder. And then all of a sudden, your borrowing rate goes from 6% to over 40% in a span of a couple of days. That's not lending and borrowing, right? Those are funding rates. And like right now, we look at some of these primitives, like they still got some iterations that need to happen. Like you go ahead and you look at how are lending rates really set in a traditional economy. Like that's not really what it is, right? It's more of set from a central bank. They decide what the cost of capital needs to be during that time period. And right now on Ethereum, believe it or not, it has a cost of capital. Right now, you go ahead, you stake to the beacon chain, you're going to be earning just a little over 3%. And then if you want to go ahead and think about what the cost of capital will be for about a year's time, believe it or not, Pendle, you can go on there and you can pull up what is the cost in terms of a rate swap for a year or two. And you can do that with its fixed rate or its implied yield right now. Like that is your cost of capital. Why is lending and borrowing not revolving around that? And some of it has to do with how some of these protocols are constructed, right? Like a bank, it doesn't just require you to drop $100,000 to take a $50,000 loan out. No, it actually prints money. It takes your asset that you want to purchase it, puts it on its books. Why haven't we really seen that explode in Ethereum? Part of it is because it has a dual currency setup, but I don't want to get down that rabbit hole. That espresso post will be coming out soon. But what I'm getting at is that a lot of the financialization that has taken place on Ethereum to date has been a little bit baked in speculation. If we can abstract away from that, kind of move to an economy type of view, like I mentioned, these staking rates, I think credit's going to be more affordable, and you're going to have more credit become available on the network. But then the last part, and I think this is the most important here, is that Ethereum is going to be commoditizing its security in a very strong way. And it's doing it through financialization of its asset, right? This is liquid restaking tokens. This is L2s. L2s come about, right? Like the use case for an ETH token changes. Can it get there? Is there an application that's going to demand that security, that data availability? I don't know. I don't think anybody really knows yet. If it can and get that catalyst of demand that we've been talking about, it's going to have an explosive move. Because again, I haven't seen the monetary conditions look this good for a token ever. And this is why I got so excited with Bitcoin, with ordinals back in the day. If you guys, I'm sure you guys remember that, where I was talking about ordinals every day for weeks and digging into that ecosystem. And now we got the L2s starting to come about. You got Bob, and nothing is like quite there. Like it's so close for the Bitcoin economy to like realize this change of usage for its token outside of kind of pristine collateral and sending payments. But like if it can cross that threshold, man, God, that thing is off to the races. It becomes the best asset hands down. But now you're seeing Solana start moving its use cases down the curve in a positive way. Like, I mean, that speaks to the maturation of the Solana ecosystem. And I think the last part, which I'll get into, and then you can interrupt me, Marconi, because I have a feeling you're getting ready to, is that Symbiotic is a liquid restaking protocol that's coming out in the market. It's proposing and it's allowing other tokens to go ahead and use their token in a similar way as Ethereum kind of getting locked up. And so what's interesting there is there's going to be this use case for a lot of tokens that have never really had a good use case. Like, I'm sorry, governance is not a good use case. Like, just because you have just because you have a lot of tokens, aka a lot of money, right? You shouldn't be able to influence a vote. Okay, that's not a democracy. So the fact that a lot of these projects and tokens can move out of governance as the main form of utility is a massive driver. And I'm very curious, and I really hope to see some of the more, I would almost say like dinosaurs, go ahead and embrace that and give it a try and see what happens. Because I think it might really change the narrative in the space at large. Like, yeah, your token should have utility. Look, this is what's happening. And perhaps, maybe if we're lucky, this discussion on these monetary principles might actually get some airtime. Right. So, I know that was a lot. I don't even remember the original question, to be honest with you. I just,
it was a question of, does your study of Ethereum for the period of time that you've been studying it, and then now having more of a formalized framework for studying it, right? One that you've developed over time, does it give you some deeper insight into what you expect from Ethereum going forward? And I think you've answered that, right? There's this almost this Rubicon that Ethereum can potentially cross, which is going from speculative credit, right, or funding over to more of a credit model and financialization, which would strengthen the use cases for M1, 2, and 3, would strengthen demand potentially for those, but it does have to cross over there, is what I took from what you just said.
Yeah, I took a bit of a shotgun approach and then hoped to hit it.
Well, yeah, there's a lot of different questions here. I mean, this entire conversation we've had thus far, we haven't really touched on network. We haven't really touched on technicals. My interpretation of that is that there is so much discussion within crypto Twitter about technicals, right? There are so many slide jockeys that can just, pull up the latest chart, look at the RSI, look at the Bollinger Bands, look at a series of technical indicators and say, okay, where is Ethereum most likely going to go next? And certainly there's some more refined metrics that you could use for that. Okay, fine. So let's take that off the table. And then from a network perspective, what is your take on that? I mean, how much of that have you evolved? Have you taken what the existing metrics are and added to that? How much of it have you just been able to leverage and then put it into this overall model, combining really this new, I would say, weight and analytical framework with monetary?
Yeah, sure. And on the technical side, like there's a lot of weight there. It is very important. And like you can RSI, MACD, a lot of these momentum indicators, moving averages, like we apply them through various domains, like even outside of trading. Like you can go into biology, look at population growth and start applying some of these similar concepts, or like, hey, this was a 2 standard deviation event in whatever biological thing you're looking at. And that is interesting, right? And now you can go ahead and make an academic paper about it. So technicals has a lot of merit. So I don't want to discredit anybody that's focusing on technicals, because I look at technicals as well. And even that is that third leg of the stool here, because if price is rising yesterday, it's more likely to be rising tomorrow, all else equal. So
well, and to be clear, when I was saying that, I guess my question would be more: have you covered or brought new ground from a technicals perspective, or are you able to leverage the existing library, the existing knowledge base for your model?
Sure. And there is one I would say that is, kind of new, kind of not. For anybody who's been trading and using some on-chain wallets and flow of capital, this will probably resonate with you. When we look at technicals, if you look at TradFi, you look at how to look at a country, the wealth of a country, you can kind of look at this metric called Gini, the Gini coefficient, which really tells you like how distributed or concentrated the wealth is within an economy. And so if you go ahead and you look at the tech era, I think we were talking about this earlier of just, when the tech giants started to come about, there was an explosion, essentially the economic productivity taking place. And because of that, there are a few winners that are earning outsized wealth relative to the rest of the population. And so now you have essentially a concentration of wealth taking place as the economy is starting to expand. This is very natural. And because of that concept, and we see it, accumulation of a token is a similar way of thinking with that, but you can use that in a technical side of things. So you can look at the technicals in terms of like what demographic of the population is accumulating, is distributing. And when it comes to like whales or shrimps, that tends to be how we look at things and talk about things. But you know what? There's like these little bands that, especially within the whale side of things, that exist, like more of kind of a sharp trader, but almost a monopoly guy, if you will, sitting behind the computer, accumulating all this capital type of mentality. Like if we can hone in on those, and that's what we do with our model, then we'll be able to really kind of anticipate price movements. That's one of those dormant type of conditions that exist in the background. Catalyst shows up and bam, you're off to the races, right? Like that's into that model as well. But on the network side of things, like, yeah, you're looking at the amount of users coming in, and not just any users, right? Like you need a certain amount of tokens in your wallet. You can't just have wallets being spun up to in ode to some of these L1s that had these great vanity metrics. Just because you have a bunch of wallets with small little deposits in it, it's not enough to go ahead and make a transaction. That's not a user you would want as a bank, for example. In an economy perspective, like that means you got a bunch of poor people in your economy. Like how much growth are you really going to have? And so, yeah, like you have to look at users through a little bit of a different lens and seeing that demographic that you want rising in order to see that expansion moment we keep talking about.
Ben, just to point on that a little bit more, when you say you're looking for certain types of users, are you able to isolate? Are you looking for builders? Are you looking for longtime investors? You use the bank analogy. Any bank is looking for a certain profile of customer depending on their sort of the risk profile. Can you just add a little bit of color to that? What you would say is maybe more of the type of user or the type of account that would add to a network's economy?
Definitely. Like if you got $20 in Ethereum wallet and you're in I think right now a normal transaction fee is only a few bucks to do a simple send. Or if you want to go ahead and do a swap right now, you're probably right at that $20 threshold. Are you going to do that swap? You're not, right? You're not. And so if we take a step back and we realize like there is a bit of a capital constraint that exists within the Ethereum network, like where is that number? Because if we kind of look at the evolution of Ethereum over time, the types of transactions that have existed from day one, simple sends of ETH, very low costs to do it in terms of gas units, versus today, you're talking hundreds of thousands of gas units. Like for a Pendle transaction, it's 400 to almost 1 million units of gas. That is, night and day. You look at your average your average basket in terms of what transactions were in it in 2000 and I think it was the later half of 2021. Whenever NFTs came on the scene, that's the time period I'm trying to hone in on. I think it was actually first half. Those transactions raised the cost to go ahead and transact, right? Like it was, you were no longer spending to swap an ERC20 or just sending ERC20s around. You were now minting an NFT. You were purchasing an NFT, which was a lot more compute. And so now if that wallet with $20 in it is realizing like a cost to go ahead and do a typical transaction on its network, it can't really participate anymore. Why is that still a user? Right? It just got too expensive. They need to move. And in 2021, we saw that movement. We saw the migration away from Ethereum into alternative layer ones like Avalanche and Binance. They earned a lot of mind share because and granted, that address is still there on Ethereum, right? Just because the user left,
right,
it doesn't mean the wallet went away. And so vanity metrics are capturing that user who really is not a user at the end of the day.
Are you able to study moving across economies? So you mentioned alternative L1s versus moving within the economy. So if you're looking at someone who's maybe they have $20 in an account, and they're saying, okay, I can't do a whole lot with Ethereum, but if I move to these layer twos, the fees are less or whatnot, I'm going to be able to actually do something with that. Is that something you're studying and just seeing the overall movement across the ecosystem?
We did. We did for a while. We're not actively following it at the moment, but the analogy there for economies is like trade partners. So, as these trade networks start to rise between, where's all the liquidity, where's all the avenues in which a user's going, where are they bridging? What networks are they moving capital off of Ethereum to go ahead and make that transaction? And this other network probably has these goods and services or applications and speculative assets that they want to go. This new network economy is going to rise because it has those users. It's got the demand, and you're seeing it through the a lot of that. And you can track that if you want to. We're just able to essentially get the same signal by just sitting there and looking at essentially those demand catalysts start to form, and you can look at the population and those trade channels. As people are leaving, they're moving. The users, the demographic of the users is starting to change. The demand for block space is starting to change as applications start to grow, new ones start to launch. You're going to see essentially the cost, the average transaction that take place on that network, it's going to rise, right? Your cost of living is rising. This is like owning a home in Manhattan or owning a business and paying rent in Manhattan is very expensive. And you want to hire labor in Manhattan, that's a high price tag, right? It's a high price tag to transact on a very populated L1 network. You go in the middle of nowhere, your labor rates are probably much less. Your rent is probably much less, but what's your customer traffic looking like? One of the criticisms to that analogy is like, well, then the user in Manhattan can go ahead and Venmo, to the shop over in the middle of nowhere, Montana or something. So, but the issue is you don't have the foot traffic, right? So the parallel isn't quite there, right? And then you got the cost to ship it as well, but then the security component of it plays into it as well. So I know that's a bit of another tangent. Tangent of change.
Yeah. So I want to come back a little bit because I just kind of summarize a couple of key points here because you've really walked through so much of the model. But I just start from the monetary side of it. It's really thinking about what are the demand areas and that are going to impact velocity. What does that have on the network? And then if I think about from a technical perspective, you've got the standard toolkit, but you've added to that sort of thinking about the value of the whales and how they're accumulating and not accumulating. So rather than just bucketing everything into the exact same, it's a whale versus a shrimp, you're actually adding some granularity to that to give you deeper insights. And I would say that's the same thing you've done on the network side of it, right? Which is to realize that, just looking at some of the gross numbers of network participants is not the same as looking at ones that are actually able to participate if desired, or actually beyond that, actively participating in the network, doing things where they're moving between perhaps M0 to M1 or M1 to M2, and even capable of doing so given the cost of the economy. So that's kind of, I would say, the areas in which this framework starts to put some new ideas out there into, the crypto world.
Yeah. And I just want to kind of come back to the beginning where we talked about if you can understand those two letters, the M, which is the supply of tokens, and V, the movement of those tokens and how much demand is happening to move those tokens. Just understanding those two things alone and just looking at whatever project you're interested in, that can change the game of your analysis. Like now you take that analogy or even just that concept of those two letters, apply them to a gaming project, right? You got a lot of velocity taking place within the game, right? You got a lot of users that are transacting frequently, but what is that token? What's happening to the token? Is it being locked up? What does the supply look like over time? Is there really that much demand taking place on that specific network? And if it's just an application on some other network, should you be owning the other network that we're mentioning that sits on top of? And now you got to factor like, okay, well, how much transactions are actually hitting the block and pushing the demand of that other chain of interest? And so now we see gaming tokens, and we're seeing kind of like it's almost a hated period for gaming.
Yeah, it is. Yep.
On blockchain. And I think a lot of it has to do with that. Like you look at Axie, it had multiple tokens, right? People were just farming the Love Potion token for a long time. The AXS token, I think that's what it was. Like it was just governance. There wasn't much use case there. And now you apply those concepts and it hopefully starts to make a little sense of kind of why that had a death spiral on its token. And as it's moving to a new chain, like why hasn't the token really recovered? Are you really using the token? Is it responsive to a change in demand of the game? If a lot of people show up in the game tomorrow, what happens to that token? I think it's hitting the Ronin chain, but that right there, like just taking those two letters, looking at whatever project you want to and applying it, hopefully, the goal here is that it helps you better understand whether your bag, if you will, is worth holding or not.
I think it's a good place to wrap this up. Is it a good bag to hold? That's kind of the ultimate question. That's what the token ratings are doing. It is a good place to wrap, but I do want to give you a little bit of promo here. How many tokens are you currently tracking on the regular?
So right now we're just following 7 layer 1 tokens, and that is mostly because if you were to go ahead and you look at layer 1s at large, not many really kind of get the green light. And we've extended it out to a point where like it doesn't make much sense to go bring in an 8th chain. And then if you start bringing in ERC20s or SLP20s or just application tokens at large, a lot of them don't really do too well. And
can you unpack that a little bit when you say they don't do well? The framework doesn't apply; it has to be modified, or their performance, their ratings are so low that you don't even want to talk about it.
At large, they're low, and also when small little movements happen, there's almost like volatility, and so you have to look at these things over a long period of time. And a lot of them do hold, but it's just, again, the ratings are low. The use cases are not that great. And the last part of the matter is like, do we want to really focus all of our efforts just on ERC20s? And, we really don't. We don't want this to be like an Ethereum centric rating. And all the data exists for ERC20s right now. That's a little bit more kind of easily accessible. And so if we had to make that decision, right? Because if we bring in all these app tokens, then we're now going to spend all of our time and energy essentially rating them all, looking at them month to month, when in reality, we want to look at these layer 1 networks as like, is it worthy for you to set up shop on this layer 1? Is it worthy for you to become essentially a citizen of the Solana network? And, through our workings, like, yeah, if you want to plant a flag in Solana, Ethereum, or Bitcoin, like, do it. If you want to go plant your flag in Binance, and I hate to say this because Phantom's been doing a lot of great work, but you want to plant your flag in Phantom, like, no, you probably don't. Is it worth visiting? Sure. But if you want to be like a citizen of one of these layer 1 networks, plant your flag and really just try to earn more of that native token or get involved in various protocols. This rating really helps with that. And then understanding what are the projects on those layer 1s that are driving the models that are influencing whether that layer 1 is strengthening or weakening. Like for Ethereum right now, you have all these liquid restaking tokens. You got EigenLayer Symbiotic there at the base with a bunch of Puffer, Kelp, Renzo, etc., that are kind of being added to that ecosystem. Like those things are driving these ratings higher for Ethereum. And so as a citizen of the Ethereum network, you should be paying attention to what's going on over there because it's impacting the models. It's influencing the economy at large. Like, yeah, pay attention. And so when Bitcoin starts to have its layer 2s and we see it influencing the models. Like, as a Bitcoin citizen, pay attention, right? That should be a project that, if you do want to be there on the Bitcoin network, spend time, money, and resources doing what you do, or even building, like, pay attention to those protocols, like, because they're impacting your economy. They're making it stronger, right? So that's the way we kind of think of it. And in doing so, another kind of secondary goal, if you will, is that, you know what, the dialogue changes a little bit to build more sustainable ecosystems, to build economies that are going to be lasting for years. And, you know, this is a note to the recent rise. It's just not just meme coin kind of vaporware projects.
Oh, throwing out a barb there to all the projects that are just doing meme coins. Ben, I appreciate you coming on the show today, breaking down your new model, part 2. For all those listeners, shame on you if you missed part 1. You're definitely going to get a lot of the thinking that brought Ben to this point where he knew he had to create his own model that would help explain why some networks are going to thrive and others are going to fall. And then obviously today, breaking down more into those models. Ben, I appreciate it. I hope to bring you back because I would love to be able to take various tokens, talk about what they could do differently. Maybe this is a love letter to all the builders out there that are actually trying to build something of value, but are maybe confused about how best to do that. We could take some projects, use your model, and start to come up with some ideas of things that they could do to improve that. I think it'd be a lot of good for the space.
That'd be great. I'd love it.
All right.
Thanks for your time, Marconi.
All right. Well, thank you. And definitely hit the like and subscribe button so that we can look to bring on more and more guests that you want to hear from, that we want to talk to and get the most off of you can. But until next time, as I say on every single show, have some dry powder, keep your mind open to these projects, and definitely be looking for what matters, not necessarily the influencers, but thinking through a critical look at how you can apply models like this and make sure you got the right thing in your bag. This is Marconi White signing off.